All right, let's dive right into this. Welcome to The Explainer. Today, we're unpacking what can only be described as a phenomenal start to the year for a true titan in the property and casualty space, HCI Group. Now, if you've been following the insurance sector lately, you know it's a pretty complex landscape right now. But HCI, well, they've just posted some absolutely staggering numbers for the first quarter of 2026. We're going to break down the data and look at their structural blueprints to decode exactly how a 20-year-old company managed to secure record-breaking earned premiums and net income. Here is our roadmap for the analysis. We'll kick things off with a quick snapshot of HCI Group, then peek inside the HCI umbrella to really understand their anatomy. From there, we'll hit the Q1 2026 financial highlights, examine their whole strategy around reinsurance and risk, and finally, wrap up by looking at how all of this is actively delivering shareholder value. So, Section 1, Snapshot of HCI Group, a $2.1 billion juggernaut. To really grasp their current success, you kind of have to look at how they've evolved. HCI Group is now in its 20th year of operation, and its 18th as a publicly traded company. But here's the thing, they are way more than just a traditional property and casualty insurer. With a market cap hovering right around $2.1 billion and a stock price sitting comfortably near $160.45 recently, they've built this incredibly diversified portfolio. They successfully blend their core underwriting with real estate and even proprietary insurance tech. It's that unique mix that gives them a really distinct edge in market dominance. Now, Wall Street actually noted a tiny revenue miss of about 1.1% for the quarter. But as CEO Paresh Patel says here, HCI completely defied those expectations on the bottom line. He noted they had an excellent start to 2026, delivering record first quarter results for earned premiums, net income, and earnings per share. Stable premium volumes, incredibly disciplined underwriting, and growing contributions from their tech arms allowed them to smash profit records anyway. It is a perfect testament to valuing profitability over pure top-line volume. Moving right along to Section 2, inside the HCI umbrella, the anatomy of the business. You know, when you buy a share of HCI, you aren't just buying one standard insurance agency. Not at all. They have their core insurance and reinsurance operations, sure, but they also have these non-insurance operations that provide incredible stability and really diverse revenue streams. We're talking an entire real estate division, claim services, and a massive 82.5% ownership stake in HCI Group. HCI is an insurance technology company that uses advanced underwriting algorithms and data analytics. This diversified, multi-layered structure is literally the bedrock of their financial resilience. But within that insurance branch, we find the primary engines driving these record profits. While they do operate several carriers, subsidiaries like Homeowners Choice and TypeTap Insurance saw modest to strong first quarter growth in gross premiums earned. And look, when your core underwriting businesses are expanding their premium bases while maintaining strict discipline, that perfectly sets the stage for the kind of dynamic earnings growth we are about to look at. Which brings us nicely to Section 3, Q1 2026 Financial Highlights. Triumphs in the data. Okay, so the absolutely crucial point before we look at the raw profit dollars is understanding the efficiency of this whole operation. In the insurance world, the ultimate metric is the combined ratio. It takes the sum of incurred losses and operating expenses and divides them by the earned premium. Basically, if this number is exactly 1.0, the company is just breaking even on underwriting. Anything above 1.0 means they're actually losing money on the policies themselves. But anything below 1.0, that means they are making a pure underwriting profit before even touching a dime of their investment income. So check this out, 0.57. That is HCI's combined ratio for the first quarter of 2026. Guys, this is an absolutely staggering figure. It proves just extreme operational efficiency. Think about it, for every single dollar they collected in net premiums, they only spent 57 cents on losses and expenses. That leaves an incredible 43-cent margin on the dollar, and that is exactly why their bottom line exploded this quarter, despite that slight top-line revenue miss we talked about earlier. When you apply that wild 0.57 combined ratio to a growing base, well, the results speak for themselves. Total revenues jumped from $216 million in Q1 2025 to $242 million this year. Gross premiums earned hit a massive $326 million. And just look at that net income line, leaping from $74 million up to $85 million. That translates to an adjusted EPS of $5.45, completely crushing Wall Street forecasts. It is just a textbook example of how disciplined underwriting combined with a higher volume of active policies creates exponential profit growth. Let's transition over to Section 4, Strategy, Reinsurance and Risk Management. Because making money is really only half the battle in insurance, right? Keeping it when catastrophes strike, that is the real test. Interestingly, HCI doesn't just buy reinsurance from outside parties. They actually own Cladigal, a captive reinsurance subsidiary. It's essentially an in-house safety net that they use to opportunistically manage reinsurance cycles, and it works. Since its formation in 2008, it has contributed $144 million in pre-tax income back to HCI. They're keeping a portion of their risk management capital strictly in-house, and it is paying huge dividends. And looking ahead, HCI just completed its massive 2026 to 2027 catastrophe reinsurance program. This is the giant safety net that protects those record revenues we just discussed. They secured a staggering aggregate limit of $4.06 billion across their portfolios. Their maximum first event retention, which is basically their absolute deductible before the reinsurance fully kicks in, is capped at about $163 million. But here's the absolute best part. The estimated net consolidated reinsurance premiums are $381.2 million. That is actually about 10% lower than the prior year. So they got more comprehensive coverage for less money. That's only going to widen those profit margins going forward. Finally, Section 5, delivering shareholder value, the payoff. Let's see what this actually means for you, the retail investor holding the stock. Because when a company posts an $85 million quarterly profit, the immediate question is, what are they going to do with all that cash? CEO Paresh Patel makes it crystal clear here. He states they plan to continue using their earnings to buy back stock. But whatever you do, don't gloss over the end of his quote, as we prepare for the next transformational opportunity. Management is highly confident, and they are gearing up for something big, choosing to reinvest their record profits right back into their own equity. So the crucial takeaway is that they aren't just talking about returning wealth. They are literally executing on it right now. Back in March, they authorized an $80 million stock repurchase program. And by the end of April, they had already aggressively bought back nearly 240,000 shares for $37.5 million. On top of that shrinking share count, they declared a regular quarterly cash dividend of 40 cents per common share payable in June. They are actively enriching their shareholders in real time with these Q1 profits. Which brings us to a final, pretty provocative thought for this explainer. HCI Group has engineered a wildly impressive 0.57 combined ratio, they've locked in cheaper reinsurance, heavily bought back their own stock, and built a deeply diversified tech and real estate umbrella. They are a $2.1 billion powerhouse sitting on a mountain of operational momentum. So as they actively prepare for it, what exactly will their next transformational opportunity be? Are we looking at another major acquisition, or maybe a disruptive leap forward in their Exeotech division? I'd highly suggest keeping a very close eye on this space. Thanks so much for joining me on this explainer, and as always, keep learning.